What should you do to save money and take advantage of current policies before the new year? I'm Eric Brenner. Join us for some answers and another money-saving offer right now on Your Wealth Health. Hello and welcome to Your Wealth Health. I'm Eric Brenner, owner of Hilltop Wealth Solutions. Thanks for joining us this morning, and if you're watching us on Facebook, please share us with someone who could use this information. And we want to thank those of you watching on yourwealthhealth.com. Joining me today is Bill Davis, a private wealth advisor for Hilltop Wealth Solutions, and he's in the studio with me, but we are practicing social distancing. And from his home office in Valparaiso, our Director of Wealth Management, Matt Arends. Bill, you know, we've kind of got the Christmas spirit here on the set.
Trying to, yeah.
So we're trying to. We're slowly decorating the tree. So this morning we've had is the first of two shows on important tax decisions and issues that could have an impact on your financial situation. And this morning we're going to take a look at issues you want to get resolved for 2020. You don't have much time left. And then next week we'll look ahead to issues you'll face in 2021. And of course we're praying that it's going to be a much better year next year. You know, the vaccinations that are in the works should really help the overall situation. So let's begin with some issues that must consider for the next few weeks in 2020. And so Bill, we've got kind of a list of things for people to consider here.
Yeah, so we picked out 6 items, Eric, that the CARES Act stimulus checks, you know, we wanted to make sure that people understood that the $1,200 that they received in fiscal refunds was not a taxable event. And so, you know, so they don't have to really worry about that. And if there was any additional stimulus money that was received, it's likely that would not be taxable as well. Unemployment benefits. This one kind of concerns us as we talked about this show and you know, issues that our viewers might face, and that a lot of people got both extended unemployment and an increase in their unemployment up through July. That if they didn't fill out the appropriate W-4 to do tax withholdings, they might not realize that they could have a taxable event that they might need to do something about, you know, prior to the January 15th quarterly payments. So we're thinking that it would make some sense for them to seek out some tax consultation to maybe determine what the tax liability might be, so that they could possibly take advantage of some of the other CARES acts that we're going to talk about in the show. The extended benefits, of course, the unemployment benefits are due to expire on December 31st. So if you have viewers that are still receiving those extended unemployment benefits, that's likely going to end, but that's up for debate currently in Congress. You know, the PPP is, I think, one of those situations, Eric, that people are not really understanding very well. You know, it can be considered a grant as long as you keep the employees. But I think what business owners don't understand is the current situation that doesn't allow them to take a tax deduction on those expenses that were funded by PPP money. And so they need to calculate that now. So think about a C corporation that maybe received $100,000 and they're not able to deduct those expenses that were funded with the $100,000. You know, at a corporate tax rate of 21%, you could be talking about $21,000 in taxes. So we're really concerned that people don't understand the current stipulations that have been written into the CARES Act that could be an issue. And then, you know, if someone were to need some money prior to year end, they might be able to tap into some individual retirement accounts because the CARES Act waives the penalty for early withdrawals for people under the age of 59 and a half. And so that might be an opportunity. And then the last thing on the graphic is that you know, required minimum distributions have been waived, but the time period to return the required minimum distribution, of course, has expired.
Yeah. So let's dig into this, our list here, Matt, a little bit. So this unemployment benefit, you know, we kind of think that maybe some people back during, you know, when really COVID hit, you know, and the unemployment started coming, they had the choice of withholding taxes, but they're thinking, I'm just going to get the maximum now. right? And this is a taxable income coming to them.
You're exactly right, Eric. It is a taxable income because it's a benefit provided by the government. And oftentimes people do withhold, sometimes they don't. And so we just are encouraging viewers right now, if you were receiving benefits, it would benefit you to take a look at the pay stubs that you get from that unemployment benefit, verify that either federal or state tax withholding were withheld. And if they weren't, now is a really good time to begin to develop a strategy on how you're going to pay that potential tax bill. So work with an accountant and advisor, somebody, IRS website. You really need to begin to do that. Otherwise, you can incur a lot of additional penalties and interest on top of that for any tax liabilities owed.
And so, Bill, one of the resources that they could use is, there is some withholding calculators on the IRS.gov site that they can work through and help determine maybe what their estimated taxes are going to be.
Right. Yeah. I mean, I think, believe it or not, the IRS website, irs.gov, can be a very useful resource. There's all kinds of tax and accounting software packages that people can leverage. We have tools. Their accounting professional certainly has tools that they can plug in the amount of income that is estimated to receive. Now we're pretty close to year end, so I think you can get a pretty good estimate of what your income is going to be and how much you've already withheld or paid in estimated payments.
So moving on to that PP, the Paycheck Protection Act. So Matt, we're really, as it stands today, that grant, which is not taxable, but as Bill stated earlier, not being able to deduct the expense, the employee expense as well. And so for those business owners, unless something gets changed, which there has been some discussion that may get changed. I mean, really running it both ways to determine so there's not this shock and tax bill for when you do your taxes next year.
You're right. You're exactly right. I think most people are probably working as a business owner with their bankers, with their tax professionals, in running exactly that scenario A and B to determine should we keep the PPP money and not write off the expenses, or should we return that money and write off the expenses? And I think most people were just in a pickle. They had to have the funding because businesses were closed, and as the economy reopened, I think a lot of them have had the ability to step back for a second and just say, did we get a nice influx of business revenue that, hey, we really didn't need that money, or just a lot of variables to consider. But what we're saying is you really just need to be aware of it. You need to begin working with your professionals because, there are some pros and cons to it, like everything that the government provides. And so that's just a big one that a lot of people are going to have to pay attention to.
So, Bill, then being able to withdraw from retirement accounts with no penalty, there are some restrictions there. You just can't all do it.
Correct.
But certainly if someone thinks they're going to need some money in 2021, maybe for a tax bill, or maybe, they're still not back full time working and so forth, maybe drawing that money out would be a good thing.
Yeah, I mean, we think it's kind of a last resort, last ditch effort. But but if you don't know, so if you don't do a tax calculation, then you don't know how what your strategy is going to be to get money to pay that liability, and so you would need to be able to prove that you were impacted by COVID, and so you had business interruption or income interruption. And so if you can do that, then you might want to go ahead, withdraw some money from your traditional IRA account or your 401k account, which could be a loan, could be, or in the case of a 401k, you could be taking a loan, and that wouldn't be a taxable event unless you left the employer and rolled over that 401k.
Yeah, great. Thanks, Bill. So we know there are a lot of decisions to make for so many of you, and we want to help. As part of our ongoing commitment to education and giving back to our community, we're offering a complimentary tax analysis. All you have to do to take advantage of this offer is to call the number on your screen. That's 574-633-1476. Again, 574-633-1476. We're offering this to the first 10 callers, and this is really a $500 to $1,000 value, but we want to underwrite the cost for you. And you can also sign up for this offer at hilltopwealthsolutions.com. Still to come on Your Wealth Health, some other tax-saving decisions you may want to consider this year. And once again, here's that phone number for our offer of the complimentary tax analysis. Stay with us.
I cannot work, do e-learning, and keep this house clean.
You should try Kay's way. We heard you were dirty, so we came in a hurry. We can't help you with the e-learning, but we can help you with the cleaning. Try Kay's way.
Welcome back to Your Wealth Health. I'm Eric Brenner, the owner of Hilltop Wealth Solutions, along with private wealth advisor Bill Davis and our Director of Wealth Management, Matt Arenz. And we're talking about the issues people need to consider as we near the end of 2020. Next Saturday, we'll address tax issues for 2021. And this is the time of year when many people give to charity. And we want to talk about another provisions of the CARE Act, and that's called the qualified charitable giving. There's an additional tax savings if you give this year. So Matt, let's go ahead and talk about some advantages people could, take tax advantage, but also help out the charities that they care about.
Sure. When we take a look at giving, Eric, a lot of times people these days with the new tax laws, it's becoming more difficult for them to itemize. And so oftentimes their giving is not a tax incentive for them. So they do it just because of the goodness of their heart, which is great, but it is nice on some circumstances to be able to receive a tax benefit. And so in the CARES Act, they provided an above the line deduction this year that will allow you to deduct $300 right off the top of your income for giving, even if you still take the standard deduction. And if you're filing a joint tax return, that's $600. So we are encouraging people to take a look at their giving and try to give at least $600 to take that deduction right off the top. The other thing that the CARES Act is continuing to provide is, although the required distribution moved out to 72 and it was waived for this year, they're still allowing people to give money out of their IRAs or qualified plans directly to charities, nonprofit organizations that do not create a tax consequence for the person giving. So that is something that we're recommending a lot of people take a look at. That is, you have to be 70 and a half years old to do that. You can give up to $100,000 a year by doing that. And so we're just telling people, those who are charitably inclined, it's obviously a great time to take advantage of some tax strategies out there, and that's the one that we think benefits many of our viewers out there.
Yeah, Bill, and this qualified charitable distribution, I mean, there's still a lot of people that we see that don't realize they can do it, and they don't know that the limit is pretty high.
Yeah, it is really high, and it's an opportunity, especially for people that went ahead and did not take their required minimum distribution. They would have had a taxable event no matter what, and I think it's a good year to maybe increase your charitable giving from your individual retirement account, because remember that you don't take out your RMD, it's going to be larger. Your IRA is going to be larger come year end, and then the factor changes another year older, and so therefore, next year's 2021 RMD could be pretty significant if they don't address it again. But yeah, people can take out, utilize their individual retirement account, move it over to a charity of their choice. It does need to go from the custodian directly to the charity. You can't take a check in hand and then go down to your church and So you need to do it properly, from custodian, check made out directly to the charity. And so any of the viewers that need some assistance with determining how to go about that, certainly we could help them out with that.
And the number's $100,000, so they can give up to $100,000. The other thing that we always want people to know is that on the tax form, so that they receive next year for 2020, there's no line item for a qualified charitable distribution.
That's really a good point. Yeah, it just says
Total
taxability
distribution.
undetermined.
Yeah, the total distribution.
So yeah, there's got to be a communication line between, between your investment professional that's helping you with the transaction to your CPA or your accounting professional.
And I know one of the things that we do as a best practice is, we record it for people, and then we send them documentation that they did it so they can put it with their tax information going in, because they may or may not know that. So now another thing that's kind of a big misconception, Matt, is capital gains tax. People talk about capital gains tax. They think maybe they're subject to it, and it's really a lower rate. So back when they had the tax law changes that were effective 2018, they kind of separated those brackets. And so we've got a graphic here to kind of show that. And let's talk about capital gains tax.
Yeah, capital gains tax is a unique one, Eric, and this one is considered for long-term capital gains tax, which has a different tax structure than short-term. So short-term would be anything 1 year and under. So long-term would be 365 days or more, and that's what this graphic is showing. And what many people don't realize is it's not the same tax structure as your ordinary income tax. So for the first $80,000 that you have in income, it would be a 0% tax rate on capital gains. And I think this is a really great opportunity for a lot of people to look through their portfolio and say, do I have appreciated stock? Do I have appreciated assets? Could be property, something of that nature that I've sold or need to sell. Maybe you just have appreciated stock that you need to diversify. You were given a lot of stock options or rights to buy stock through an employer plan, something of that nature, and you just feel like you're too consolidated to one stock, and you have gains. This is a great opportunity to say, what's my tax structure, my income structure look like this year? Could I sell some of that, diversify, and not even be exposed to capital gains tax? And so these brackets provide you that information. You can see even somebody paying a 15% tax rate has their income range has to be between $80,000 and almost $500,000. That's a massive tax bracket range. And we're just saying, hey, it's worth taking a look at those opportunities, especially since most viewers that we talk to express that their belief is going forward, taxes are probably going to be going up in the long term. And so this is a great opportunity for people to say, are there advantages that I can do, things that I can do today to potentially sell some assets and not even have to pay any income tax on it.
Yeah, Bill, so we often, call it weeding the garden, at the end of the year, kind of looking at your losses, because you can take losses on your tax return up to $3,000 a year. Anything above and beyond that, you can roll it, it kind of gets banked, and you can take losses and offset gains. So sometimes there's some opportunities there. So really need to take a look at that overall. And that's certainly one of the things that's been talked about with the Biden administration is the capital gains rates going up.
Yeah, you definitely need to do tax harvesting in December, and I don't think there's a doubt in my mind that you're going to see the capital gains rate change and go up.
Yeah, I
think this is an unprecedented time with the low capital gain rate.
Yeah. So another tax saving investment, is 529 plans. So I think they're designed depending on the state, right? But to get a state tax credit.
Yeah. Yeah, so in the Indiana 529 plan, an individual can contribute, can get a tax deduction, a tax credit for up to 20% of the contributions they make, up to a maximum of a $1,000 credit. So if you think about that, $5,000 contributed on behalf of a child or a grandchild into a 529 plan in the state of Indiana can be a $1,000 credit. I want to point out that's significantly different than a deduction. Mm-hmm. So if you were break even on your Indiana income taxes, you could get a $1,000 refund, which there's a 20% return automatically that we have no other investments that give you a guaranteed 20% return.
And you can do this for your grandchild too,
Yep,
or grandchildren.
absolutely. That's what I do for my 3 grandchildren.
Yeah, so it's a great thing. So, well, at Hilltop Wealth Solutions, we are committed to education and giving back to our community. And we know that you need help with your tax decisions. So we're offering this complimentary tax analysis. To take advantage of this offer, just call the number on your screen, 574-633-1476. That's 574-633-1476. We're offering this deal to the first 10 callers. It's a $500 to $1,000 value, and we'll underwrite the cost for you. And you can also sign up for this offer at hilltopwealthsolutions.com. Still to come on Your Wealth Health, some final thoughts about tax issues and priorities as 2020 nears the end. Stay with us.
Built on a legacy 4 generations strong. Clayton Hoover & Sons Home Improvement. More than just our business, it's a family legacy.
Welcome back to Your Wealth Health. I'm Eric Brenner along with Bill Davis and Matt Arenz, and we're discussing the end of the year decisions people need to consider. And next week we'll discuss 2021 tax decisions. Bill, you know, we talked about some different issues, tax things to consider for 2020. It's hard to believe we're talking 2021 already.
I know.
But let's prioritize them for folks.
Yeah, so number one is if you did receive unemployment this year, we'd like you to determine whether you withheld taxes or not. And if you didn't withhold taxes, we really need to make some calculations, some rough calculations on what your tax year is going to look like prior to getting to the end of the year, so you can come up with a plan on how you're going to pay that liability. For our corporate partners out there, you know, we need to be thinking about the PPP money, the payroll protection money. So if you did receive that and utilized it to either fund operations, rents, mortgages, payroll, need to look at with your tax professional what the impact of not being able to deduct that for your 2020 tax year, because there could be some significant liability depending on the type of corporation that you are. And then, you know, one thing we didn't discuss, Eric, that a lot of people are asking us now is the deductibility of a home office with so many people working from home.
Yes.
And, you know, we tend not to take advantage of that because it is a very complicated calculation that, you know, you need to understand what the long-term implications because that's a depreciation of your home, and could down the road when you sell your home have some implications. But it's certainly worth talking about for people that utilize utilize their home for a lot of this year. And I know for Matt, you know, has talked about the capital gains, so maybe you touch base on that, Matt.
Yeah, and I think exactly, Bill, the capital gains just being one last thing to look at. Are there opportunities within your portfolio to either claim a loss and write off some losses on your taxes up to $3,000, or are there opportunities to capture some capital gains, capture some profits, and keep yourself within a certain range of income to either pay no income tax on that capital gain or pay a 15% knowing that potentially capital gains will go up in the future. So I think those are the biggest things, and I think it's just something that we're telling viewers there's a lot of options out there. Distributions out of the IRA, qualified charitable contributions. That's another thing that we want to make sure that people are taking advantage of. But there's an array of things out there. Not all of them will benefit you, but or be applicable. But we're saying begin to dive in, and now's the time to do that before year end.
Yeah, and you mentioned, Matt, the qualified charitable distributions. I know our firm, we believe in giving back, and we provide a matching program for clients that contribute. We want to match. And we're going to talk to the representative here with Toys for Tots. And so, we just feel like if someone, hasn't been as affected with COVID-19, utilize that qualified charitable distribution or that other one-time deduction off the top.
600.
Yep, up to 600, and really making sure that, you're helping good in the community, but also saving some tax money.
Yep.
So, good.
Yep.
That's good. Thanks, Bill. Thanks, Matt. So at Hilltop Wealth Solutions, we are committed to education and giving back to our community. And we know you need help with your tax decisions. So we're offering a complimentary tax analysis. And to take advantage of this offer, just call the number on your screen, 574-633-1476. Again, 574-633-1476. And we're offering this deal to the first 10 callers. It is a $500 to $1,000 value, and we will underwrite the cost for you. And you can also sign up for this offer at hilltopwealthsolutions.com. At Hilltop, we also work hard to help out some of our local charity organizations. And one of those organizations we've done a lot of work with over the years is Toys for Tots. And today we are honored to be joined by the Toys for Tots South Bend Coordinator, Sergeant Scott Colgrove. Scott, thanks for joining us today.
Hey, it's no problem at all. Thank you.
So, I know we have a drop box at the office, and we've done that for several years. So, how can people help out for Toys for Tots?
Well, currently our mission right now is to collect new and unwrapped toys to distribute to children that are less fortunate at Christmas time.
So, Scott, I would assume that that the need is, with everything going on with COVID-19, the need's got to be just greater than ever this year.
Well, as you know, COVID-19 impacted a lot of families. Toys for Tots actually helped out in the summer and spring of this past 2020 school year to help children of less fortunate that were out of school.
Wow, Scott, so really something that maybe a lot of people don't know, it's not just around the Christmas season then that the whole program helps out these children.
Yes, it's known to help out a lot of children throughout the year, especially those in need.
So, Scott, for our viewers that are looking today that are just going to participate for the first time this year, can you help us determine, where can they go to drop off toys, and is there any, toys that are more sought after than others?
Normally, our usual amount that we'd like to look for is toys that are less than $30 this year. And they need to be new and unwrapped. There are several drop box locations around South Bend, Mishawaka, all around St. Joseph County. So if they need a specific location, they can go ahead and call our Toys for Tots cell phone number, which is located on our local website.
Yeah, in fact, Scott, we're going to show that here in a second. And so, Scott, I really appreciate you taking a few minutes out and sharing for Toys for Tots. It's a great program. I'd encourage you to drop off toys. You can do it at our Mishawaka office, or there are many sites throughout the community. So if you want more information, you can go to toysfortots.org, and you can find out how to donate locally, and find out your drop sites as well. And we just encourage people to really donate and make that organization, even this year, more so, as Sergeant Scott said. So, well, we're out of time for today. So I would like to thank Bill Davis and Matt Arenz, and for the entire Hilltop team, we want to say thank you so much for watching this morning. We'll see you next week, and until then, stay wealthy, Michiana.